What's the interest rate? That's the million-dollar question. The all-in-one is available in one of three options: a monthly variable rate, a 3-year ARM, meaning it's fixed for 36 months, or a 5-year ARM, meaning it's fixed for 60 months, at which point it starts varying every month. The interest rate will be a combination of a margin that you get to choose. Most people choose 3.5% because it doesn't cost any discount points. The margin will add to that month's index. The index we use is the 1-year constant maturity treasury index. It's just an index that banks use to determine interest rates. So let's say that the CMT index is at 1% this month, and your margin was 3.5. Your interest rate for that month will be 4.5%. Let's say the index shoots up to, say, 4%, which it's done at the end of this 2022 calendar year. Index is 4%, but you bought your margin down to 2.5%. Your interest rate is 6.5%. The margin will be consistent all the way through the life of your loan. The index can change every month. Your interest rate will always be the sum of the margin and the index. Couple caveats. One, there's a floor to the AIO, meaning your interest rate will never go below the floor. Let's say you buy the margin down to 2.5% and then the index drops to 0.5%. That can happen. It was like that earlier this year. Your interest rate, you would be like, oh good, it's 3%, sweet. No, the floor is 3.75, meaning even if the margin and the index add up to less than the floor, your interest rate will be the floor. So 3.75 is the lowest it'll ever be, and the highest your rate will ever be is 6 points higher than it starts. So let's say you started out at 5%, your interest rate will never go above 11%. The floor in an investment property is 4.75%, not 3.75. So you can figure out how that kind of works. Everything else is the same though. Margin, index. One more thing about that CMT index. When mortgage rates around the country are rising, that index is going to be rising. When mortgage rates are dropping, that index is going to be dropping. And so even if you're like, I don't know about this whole thing, like what if I get stuck in a high rate? Well, you won't. If you're in a monthly variable, if interest rates around the country are dropping back down to the 6s, 5s, 4s, 3s, so will the all-in-one. It'll do the exact same thing. It'll just follow what all of those are doing. So not too much to worry about in terms of that index, as long as you're comfortable with. There might be months where that index is up, high 4s, maybe 5s, 6s even. We haven't gotten there yet. We could. I don't think we will, but we could. I think that index is going to keep coming down as inflation gets under control, as mortgage rates are coming down over the next 6-9 months, God willing. We're going to see rates in the all-in-one go down as well. Again, it makes sense to buy that margin down so that no matter what your rate is, it's a full point lower than that, than if you'd just taken the par margin. That's how the interest rates work in the all-in-one. And the biggest question, when people ask me, what's the rate? I want to say, why do you care? The answer is usually because I don't want to pay so much in interest. And I say, then don't even worry about the rate. In the all-in-one, we're not gambling on interest rates rising and falling. We're banking on income to expenses being such that we're aggressively driving down the balance, thereby shortening the term, thereby saving fortunes in interest that would never have been available to us if we had extended the term the full 30 years and just paid the minimum for that time. Interest rate, it's important, but so is balance, which is accelerating on its way down in the all-in-one, and term, which is abbreviating in the all-in-one. Interest rate matters, but I don't even pay attention to it. I'm not worried about it. Neither should you be.